Europe targets U.S. fintech giants in a new crackdown.
Digital currency war ignites across the Atlantic.
U.S. banks rush stablecoins. EU strikes back with regulation.
The stablecoin showdown begins and billions are at stake.
This isn't just regulation, it's retaliation. Europe just fired the first shot in a financial war that could end America's dominance over digital money. As U.S. banks race to mint their own stablecoins, Brussels is tightening the walls, banning unlicensed coins, limiting U.S. platforms, and rewriting the rules of global payments. If the dollar ruled the old world, Europe plans to rule the next one through code, not cash. It started quietly, a few lines of legislation, a few pilot projects, but by 2025, it exploded into a race for the future of money. U.S. banks and fintech firms saw stablecoins as the bridge between traditional finance and crypto. Tokens backed one-to-one by the dollar, regulated but fast, programmable but trustworthy. The market surged past $150 billion in circulation worldwide, with Tether and Circle's USDC leading the pack. JP Morgan, Citi, and PayPal followed, each launching digital dollar projects to compete in a new era of instant payments. Then came Brussels. Europe had watched Silicon Valley and Wall Street control its digital economy for a decade, from social media to cloud services, and now money itself. So in 2024, it rolled out MiCA, the Markets in Crypto Assets Regulation, the world's first comprehensive law to govern crypto and stablecoins. Under MiCA, only licensed issuers can operate in the EU. Every stablecoin must be fully backed by verifiable reserves, audited monthly, and registered with European regulators. On paper, it's consumer protection. In practice, it gives Brussels power to decide which currencies circulate in a $17 trillion market. That means a US company can invent the tech, but Europe can decide if anyone is allowed to use it.
By early 2025, the U.S. Congress was still debating its own stablecoin bill. One draft would place issuers under the Federal Reserve, another under state charters. Nothing passed. While Washington argued, Europe acted. The result, banks on both sides rushed into a regulatory arms race. Citi teamed up with the European Banking Federation to pilot a euro-backed coin for cross-border settlements. At the same time, JP Morgan expanded its JPM coin network into London and Frankfurt, testing real-time tokenized payments between US and EU clients. But beneath the innovation was tension. European regulators began drawing hard lines. US stablecoins like USDC or PayPal USD couldn't be offered to European users without local licensing. Unregistered tokens risked bans or fines of up to 5 million euros per violation. That's not guidance, that's gunfire in a regulatory war. To understand why Europe is doing this, look at the past 20 years. Every major digital revolution, from Google to Facebook to Apple Pay, was American. Europe imported innovation and paid the price in data and dependence. The new digital finance push is Europe's revenge arc, its chance to write the rules before America does. MiCA and the Digital Markets Act work together like a dual strike. One controls crypto, the other controls tech. Together, they form a regulatory firewall that forces U.S. companies to play by European rules or lose access to 500 million consumers. It's policy as power, bureaucracy as a weapon.
The stakes are huge. The global digital payments market is projected to hit $50 trillion by 2030. Whichever region sets the standards for stablecoins could control how that money moves, how fees are collected, and who gets to see the data behind each transaction. That isn't just finance, that's sovereignty. And Europe is moving fast. The European Central Bank is testing a digital euro pilot across 20 banks. France and Germany are backing blockchain settlement trials for bonds and cross-border trade. Meanwhile, European cloud firms like OVH and Deutsche Telekom are pushing data sovereignty projects to keep financial records within EU borders. Every step reduces US influence and builds Europe's own digital fortress. On the surface, US banks say they welcome clarity. Behind closed doors, they're worried, because for the first time in decades, Europe isn't following America's financial lead, it's setting the agenda. And if US firms can't meet Europe's new requirements, real-time reserve audits, onshore data storage, capital ratios for tokens, they could lose access to the world's second largest economy. Imagine Apple Pay, PayPal, and USDC suddenly restricted across the EU. It's no longer unthinkable. And Europe's motives aren't pure economics, they're strategic. The US uses the dollar as a tool of foreign policy, sanctions, swift controls, financial pressure.
Brussels watched that for years and decided to build its own shield. By creating an independent regulatory currency network, Europe can transact beyond American jurisdiction. It's not just about money flow, it's about power flow.
This is why EU officials call MiCA a digital sovereignty project. Every line of code becomes policy, every license becomes leverage, and for Washington, it's a warning shot. Meanwhile, in the US, fintech firms feel trapped between two worlds. Regulation at home is uncertain. Regulation abroad is aggressive. Stablecoin issuers like Circle have already moved compliance teams to Paris to apply for MiCA approval. Even PayPal, an American icon, is setting up European subsidiaries to avoid being blocked. But relocation comes at a price: jobs, capital, and control. Each firm that moves its headquarters to Europe takes a piece of America's fintech lead with it. This isn't outsourcing, it's surrender by regulation. The story is bigger than crypto or payments. It's about who defines digital trust in the 21st century. When the US invented the internet, it set the rules of freedom and scale. Now Europe is writing a new manual. Privacy first, sovereignty second, profit third. And that manual could become global law if others copy it. Already, countries like Singapore and Australia are using MiCA as a template for their own crypto rules. If Brussels wins this battle, American firms won't just lose Europe, they'll lose the global standard. That's what makes this fight so dangerous and so personal for Washington. What began as financial innovation has turned into a sovereignty struggle. Europe calls it regulation, America calls it overreach. But beneath the politics is the same question every empire faces when its currency meets a new technology: who gets to own the future of money?
The shockwave of Europe's crackdown didn't stop at Brussels. It rippled straight through Wall Street. Within months of MiCA's enforcement, US fintech boards began emergency meetings. What looked like compliance updates suddenly turned into survival plans. Circle, the issuer of USDC, once the darling of regulators, applied for an EU license but froze new European listings until approval. PayPal's Euro stablecoin faced new disclosure demands. Banks like JP Morgan and Citi had to audit reserves in real time to keep corporate clients inside Europe's payment rails. The message from Brussels was unmistakable: follow our rules or stay out of our market. For US executives, that changed the math. Every compliance cost now reduced their global margin. Every new rule risked splitting their infrastructure, one system for America, another for Europe. The very idea of one global internet of money was collapsing into rival digital zones. Meanwhile, Europe's plan was working. European fintech firms, once overshadowed by Silicon Valley, began rising fast. Berlin-based Bitpanda partnered with Raiffeisen Bank to issue euro-denominated tokens. French startup Société Blockchain Services launched fully MiCA-compliant stablecoins backed by ECB-approved reserves. And for the first time, venture funding for European fintech hit $90 billion in 2025, overtaking the US quarter-on-quarter in early growth stages. Regulation didn't kill innovation, it relocated it.
The implications reach beyond finance. At stake is data. Who stores it, who reads it, who profits from it? The Tech Policy Press report notes that Europe's digital trade expansion combines fintech regulation with strict cloud sovereignty rules. That means transaction data from US firms operating in Europe must reside on EU-based servers, protected by GDPR and national security protocols. For Amazon Web Services or Google Cloud, that's billions in infrastructure duplication. For banks using those clouds, it's compliance nightmares. And for ordinary users, it's higher fees baked into every transaction. Europe calls it privacy. US firms call it protectionism. Both the right, depending on which side of the Atlantic you profit from. Behind the headlines, something deeper is shifting: the architecture of global trust. If MiCA succeeds, the EU, not the US, sets the template for digital asset supervision worldwide. Asia and Latin America, watching the chaos in crypto markets, are already copying Brussels' model. Singapore's 2025 Digital Payments Act mirrors MiCA language. Brazil's central bank draft uses its reserve ratio framework. This is how empires extend influence without armies. They export regulation. For the US, that creates a new kind of vulnerability. If foreign governments decide whose tokens are legal, America loses control over the distribution of its own digital dollars.
That undermines the very mechanism that made the dollar dominant: universal access and trust. And once trust fractures, so does power. International trade could split between two digital standards, one anchored in Brussels, one in Washington. Transactions between them would face conversion fees, compliance checks, and data transfer gates, the digital equivalent of customs borders. The borderless finance dream could die in the same decade it was born.
Still, Europe's victory isn't guaranteed. Its own banks worry about liquidity traps if stablecoins grow too fast. The European Central Bank warns that private digital euros might drain deposits from traditional banks in a crisis. And tech leaders warn that too much bureaucracy could drive startups to Switzerland or Dubai. Imperative: regulation is a double-edged sword. The same rules that protect can also paralyze. Even so, the momentum feels irreversible. Once Europe tasted the power of writing the world's financial code, it won't give it back. Across the Atlantic, Wall Street is adjusting its strategy. Large banks are forming cross-Atlantic alliances, joint ventures that register under MiCA but route profits through U.S. parent companies. It's legal gymnastics and a sign of how deep the tension runs. Startups without global law teams can't keep up. Many simply exit Europe. Imperative: innovation is becoming a luxury only the largest players can afford. And that brings us to the most human question. What does this mean for ordinary people? Short-term, users may see more security, fewer scams, and fewer meltdowns like FTX, but they'll also see higher fees and fewer choices. Some popular US apps might vanish from European stores. Others could split features by region, turning a global digital wallet into a patchwork of local versions. Imperative: the Internet of Money is becoming the Internet of Borders. There's a larger irony here. Crypto was born to escape government control. Now it's governments fighting to control crypto. Stablecoins promised freedom from banks. Now banks are issuing them. The system that was meant to decentralize power is becoming a tool to re-centralize it under new hands.
And for the US, that means the hands now belong to Europe. So what comes next? A US countermove is inevitable. Treasury officials are quietly studying a digital dollar network to compete with Europe's model. The Federal Reserve Bank of New York has expanded its CBDC pilot with major banks, and the White House is floating a digital trade pact to protect US payment data abroad. But none of that is ready today. And today, Europe leads. By 2027, the map of money could look completely different. One side regulated by algorithms written in Brussels, the other governed by laws still argued in Washington. The question isn't who wins the regulatory war, it's who loses the trust first. Because in finance, trust is currency. Lose it, and no law can print it back. If the dollar ruled the old world, Europe wants to rule the new one, through code, not cash. And as this crackdown spreads, one thing is certain: the battle for digital money has only just begun. Regulations used to follow innovation. Now they lead it. For the first time in modern finance, lawmakers, not founders, are writing the future of money. And if America doesn't catch up soon, its greatest export, the dollar itself, might become someone else's code.